StoneCo is one Cathie Wood stock down 87.93% that I think you might regret not buying on this dip here. Of course, Cathie Wood is attracted to innovative growth stock, and her combination of ARK portfolio of investments has many stocks, over 100 stocks, and StoneCo is one of those holdings in her portfolio, although not a significant holding, 0.21% of the overall portfolio of holdings. Still, it's chosen by Cathie Wood, and I tend to agree with her on this investment, and I'm going to talk about why I think that's the case for StoneCo. Starting with looking at StoneCo's revenue over the trailing 12 months, you can see explosive growth here for StoneCo, 2.141 billion of revenue for this financial services e-commerce enabler type company that's located in Brazil. That may be one of the reasons why investors are getting this stock at such a discount, is because of the higher risk in investing in a stock outside of the U.S. Those tend to come with a discounted valuation compared to their similar companies in the U.S. doing similar things with similar financial metrics, but just because the companies established outside of the U.S., there tends to be a discounted valuation to them. And looking at the revenue growth, 2.14 billion, that's way higher than the, let's say, 500 million it was at in 2018. So nearly 4x growth in revenue. And this company is not just growing revenue, right? It's growing profitably. Operating income in the trailing 12 months, 850 million. Big jump from the 250 million last year, and less than 125 million in 2018. So you look at 2.14 billion in revenue and 850 million in operating income. That's a profitable business. That's a lucrative business model that's generating $850 million in operating income on 2.1 billion in revenue. So turning revenue into profits at a very effective and efficient rate. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. Then finally, the last reason why I think you might regret not buying this Cathie Wood stock on this 88% dip here is because of the valuation. StoneCo stock is trading at a forward price to earnings ratio of 13. That's near the lowest it's been going back all the way to January of 2022. So you're getting this company that's demonstrating very nice revenue growth, very nice profitability, and you're buying it at a reasonable valuation at near its lowest valuation it's been at over a year and a half. Now, you're all aware that these types of growth stocks are down significantly off their highs because one of the main reasons the Federal Reserve has been increasing interest rates, and that's caused investors to be less willing to buy growth stocks or stocks for that matter, right? Because now you have a higher opportunity cost of capital, a higher opportunity cost of capital. Instead of investing in StoneCo stock, you could take your money and put it in a very safe bank savings account or certificate of deposit or money market fund earning between 4 and 5% with almost zero risk. So if you can get almost 5% on your money with zero risk, now that's going to cause a lot of investors to take money out of stocks and put it into these safe investments at 4 or 5% because that's a pretty good yield. That's a pretty good return on investment with zero risk. And so that's made stocks less attractive. One of the reasons that it's made stocks less attractive, and it's brought the valuations down significantly, but that the stock prices have come down so much that now they're a pretty good value, at these, inexpensive valuations. So I think for that reason, you might regret not buying this Cathie Wood stock on the dip. Anyhow, thank you so much for watching. I really appreciate your viewership, and I hope you'll come back again next time for another video.